You have to know this about insurance. When I go to a cocktail party at Ruth's Chris Steakhouse, I am telling people this. Hey everybody, it's Dave Hathaway bringing you another educational episode. Today, we're going to discuss everything investors need to know about insuring rental properties. And in this episode, we're going to go into depth about biggest mistakes investors make in regards to insurance, most important things that need to be in your policy, how to estimate insurance when you're analyzing a deal. That one's specifically for my deal analyzer. And rule of thumbs for filing claims, deductibles, and coverages. But since I am not an insurance expert, I wanted to bring on somebody that I can interview, that can bring the value and the content that is necessary. So I wanted to introduce Ryan Daubert. He is owner of Lehigh Partners. And Ryan, thank you for joining us. If you wouldn't mind just giving us a little bit of introduction about how you got into insurance and how you're able to speak about insurance.
Sure, absolutely. Well, thanks, number one, for having me on your show. And yeah, I'll give you the 30,000-foot flyover here. So when I graduated college, any other new college graduate didn't line up a job before they graduated. Sent my resume out, had a couple offers back. One was for insurance sales. Didn't know anything about the industry, but it certainly paid enough for me to get out of my parents' house. Went ahead with that career, learned everything, got licensed, worked for that company for about a year, and then kind of saw some things I thought could be improved, specifically around customer service, and thought, I might be able to do something better on my own. So started the agency from scratch. Didn't really have many carrier appointments to begin with. As a matter of fact, none. So kind of just built our markets up, built our client base up, and kind of hit the ground running from there. So fast forward 12 years later, we have 15 employees, do a little bit of everything from investment properties, obviously, home, auto, life, benefits, everything. So I always kind of make the joke that if it has insurance in its name, we could probably help you out, except pet insurance. That's the only thing we don't do. So don't ask me about that because I won't have an answer for you.
Awesome. Well, awesome introduction. And you have a little bit different background. Do you also have investment properties yourself?
I do. Yep. Yeah. So primarily all up in Pennsylvania. So I've one Airbnb property out of state, but everything else, 12-month leases in Pennsylvania, mostly around Allentown, Pennsylvania.
I love that because it gives you a perspective that's unique. I mean, normally when people come to me for advice on rental properties, I love to give them the perspective of, if it was my property, this is what I would do. If I was renovating the property, this is how I would. And so it allows you to do that because you have rental properties. So you can go, I can put myself in their shoes.
Yeah. I mean, I've seen it from both sides. So, I know what's important to investors because I know what's important to me. I know some of the unique challenges that come with insuring investment properties, and dealing with tenants and kind of navigating, that side of the house too. So yeah, I mean, it's definitely a value add. I feel like for us, just have a better understanding of, what our clients are going through and, how best we can help them. So yeah.
Gotcha. I want to dive right into it. But right before that, is there a difference between landlord insurance and rental insurance? Are they the same thing and they're just called?
Yeah. So you'll kind of see in the insurance industry, there's a lot of terms that can either be misused or there's two different terms or five different terms for kind of the same thing. And we'll get into it too. But even in certain policy language, there's five different terms for the exact same thing. So we kind of call just landlord insurance, like investment property owner insurance. Okay. Nomenclature can get a little tricky if, because there is renter's insurance, which is what your tenants should have. But generally speaking, investment property owner insurance, that's probably the best catch-all term for that.
Gotcha. I saw a bunch of different ones and I was looking it up and I was like, I'm just going to ask Ryan on this one.
Yeah, it's frustrating. I mean, I'm not a gigantic fan of government regulation in a lot of industries, but insurance is the one I think they could take a more active role. One of the things that, and again, we'll get into it, I'm probably jumping ahead, but we'll see 5 different quotes from 5 different companies. They all look completely different. So unless you're really looking at it every day from the consumer standpoint, it can get kind of tricky to navigate for sure.
Gotcha. And today, for narrowing it down for the audience, we're just going to be discussing investment property insurance. We're not discussing anything else. So homeowners insurance, not really even going to go into it. to try to keep it niche. And so it's directed to people that are purchasing investment properties and they need to know how to insure those properties. Do you have a story that shows the importance of why insurance is important?
Yeah. So this didn't happen to one of our clients, but it was a nightmare scenario from one of the peer agencies that the owner that I kind of chat with. They had a client who bought a property on, I think it was like a Monday or something like that, forgot to get insurance. They went to settlement that morning. That evening, it had a total loss fire. So they, without insurance, there's no one stepping in to kind of reimburse that loss. It was a cash purchase, so there wasn't a lender involved, but there was I believe it was a 4 unit, if I remember correctly. So not a small property. And then that was it. So they paid their money and went away. The only type of compensation they got was when they went and sold the lot. So that's kind of our nightmare scenario, and kind of like hedge from that. I always try to tell people to let us know, like, as soon as you go under agreement, or even if you're just looking at stuff, like, let us know. But we see that more often than you'd think, where it's just someone settling on a property, cash purchase, maybe they forget to get insurance, and then, we're kind of scrambling to try to prevent that situation from happening. But
Yeah.
that would probably be the nightmare scenario that comes in front of mind for me is buying something and same day losing all your money because it was destroyed in a fire.
Total loss. Best investment he's ever seen.
100% loss right out of the gate.
Yeah, that's terrible. Biggest mistake that you see investors make in regards to property insurance on investment properties?
Yeah, so I'd say probably number one would be settlement terms. So there's really three main ways that losses settle. So the one that we always recommend is replacement costs. So God forbid the property is damaged or destroyed, or anything in the property that you're insuring is damaged or destroyed. The carrier's going to replace it, whatever it costs to buy that object brand new. So that's always our recommendation. Those policies with full replacement cost language are set in stone. There's really no ambiguity or letting a human come in and settle that loss. Whereas the opposite side of that is actual cash value. Actual cash value is market value minus depreciation. God forbid that property has a loss, a human adjuster comes in, and then they start at the market value. So they say, well, you just bought this property for 100 grand. So that's, your insured limit on your property. That's the fair market value. But, unfortunately, your roof is 20 years old. So we're going to knock off 20,000 for that. You have original plumbing. So we're going to knock off another 10,000 for that, so on and so forth. So they depreciate it from the market value. So number one, you're not rebuilding it. And the second thing is you're not going to be able to afford to buy something that's comparable because of that depreciation that they factor in. And I always say too is whenever you're having a third party kind of decide on behalf of the for-profit insurance carrier how they're going to settle your loss, it's not necessarily always going to be in your favor. So you want to try to avoid all those ambiguities around claim settlement. Avoid actual cash value, replacement cost, definitely what you want to do. And then the third kind of settlement term, which is sort of a blend of both, which we've seen more frequently in the last couple of years, still something to be avoided, but what they call functional replacement cost, which the carrier is only obligated to rebuild your structure. So it's functionally similar as how it was before the loss. So if you have like a nice solid brick home, crown molding, hardwood floors, granite countertops, they can come in and just rebuild it, vinyl sided, drywall, frame built. So obviously you can potentially lose quite a bit of equity value if they come and just build like literally the most basic structure that's the same square footage. So functional replacement costs you kind of have to be careful with, because kind of what I was saying earlier is every policy that you're looking at, if you run 5 different carriers, you're going to see 5 different quote proposals, and it's not always readily apparent what type of settlement term is on there. It's kind of like between the lines is where you got to read. So some carriers will disclose what it is right on the front. Some it might be in a further section of the policy. So that's the most common thing we see, where mistakes are made.
Gotcha. And just to clarify, you're talking about, is it a box you select when you're with the insurance agent, or is that you're saying you need to dig into the policy that they say, hey, this is your policy to say if it's functional, if it's cash, if it's replacement cost?
Yeah. So most policies, you will see it on the page where it outlines your coverage called the declarations page, which
Okay.
is one of the first pages in there, but it's not always there. So, and I don't want to disparage any other carriers or anything like that, but we see it quite a bit with Allstate, where their policies will say replacement cost on the front. So, the average consumer just sees replacement cost, thinks they're all good. And then down on the second page, it'll say dwelling settles with functional replacement cost terms.
Mm,
So it's
okay.
just something that you just want to double check. And, again, a majority of the carriers will say, replacement cost, actual cash value, but you just have to be careful. Also, you can kind of, in lieu of seeing that language, you can also kind of tell a lot of times by the dwelling coverage limit. So like specifically with an older, like say row home, that's solid brick, plaster walls, chances are in most areas it's going to cost more to rebuild than it would just to go buy something comparable. So the replacement cost, your coverage limit, will be pretty significantly higher than what your actual purchase price was.
Mm.
Whereas actual cash value terms, it'll be a lot closer to what the actual purchase price of the home was. But then again, keep in mind that the actual cash value, they factor in depreciation on that then too. So you're not going to get your market value back.
You believe that's one of the biggest mistakes investors make? Is that just because they don't understand that it's not an apples for apples thing, or is that because when they do have a claim or a total loss, that they're like, wow, I thought I was getting $300,000. Now I'm only getting 150 because that's what I paid for the
Yeah, well,
property.
most lenders won't lend against actual cash value policies. So the nightmare scenario there is that you buy a home for 200,000, have a mortgage for 180,000, and you bought a $200,000 actual cash value policy. God forbid it burns down to the ground. After they factor in depreciation, maybe get 100,000 out of it. So the bank doesn't just say, no, you're good. We'll eat that 80 grand. So they'll still come after you because you still owe that the balance of your mortgage for a house that you can't afford to rebuild. So
That
that's
is,
like really where you can kind of get in trouble with the more limited settlement terms. Also, the price delta between replacement costs and actual cash value isn't what it used to be. 10, 15 years ago, a lot of investors would go more towards ACV products because there was a bigger delta in price. But carriers have really kind of tightened up that gap. And part of it, and this is kind of my own opinion, is that I just think there's a lot of litigation risk from carrier side that if they don't accurately explain kind of some of the downsides of actual cash value coverage, that there's obviously a much greater litigation exposure for them there. So the pricing is really kind of not quite parity, but it's getting a lot closer. So you don't see ACV as much anymore, but it is still something that we certainly still come across.
Gotcha. If we think of insurance as like, this is how I think of it. Think of it as like cogs. You have all these, a few different things that you can adjust. What can you adjust that can decrease your policy? What can you adjust that can increase your policy? What are those main factors in there?
Yeah, so the main driver of insurance pricing is definitely your dwelling coverage. So what it would cost the carrier to rebuild the structure. So, obviously if they're rebuilding $1 million home versus, $100,000 home, they got more skin in the game. So that's going to be the biggest premium determining factor is the actual dwelling coverage limits. What I always advise clients, and it changes for everyone, depends on your investment experience and, kind of your war chest per se. But the biggest way to impact premium without compromising coverage is looking at increasing your deductibles. Generally speaking, like you don't ever want to, if you have $1,000 deductible and piece of siding blows off and it's $1,300 to repair it, that's not something you want to put through insurance. These billion-dollar companies don't really care about paying essentially a $300 check after you pay your deductible if they can charge you $200 a year for the next 5 years. So really shouldn't be submitting small dollar claims anyway. So by going with a higher deductible, they'll still protect you from, those financially devastating scenarios like, total loss fire. A small deductible change is going to make much of a difference at the end of the day in a scenario like that. That definitely has a pretty meaningful impact on premium.
Sounds like another big mistake that investors might make is placing a super small claim or something that's, $1,000 above their deductible.
Yeah, I mean, insurance was invented originally to protect owners of big merchant ships. If their ship went down, it's obviously completely devastates their livelihood. So a bunch of ship owners got an, kind of got an agreement that, hey, if we're each going to contribute a little bit of money to this fund, and if one of our ships goes down, we're going to pull from the fund and cover that loss. So that's really how insurance was, invented. And I always kind of equate it back that it was designed for catastrophic occurrences. It really wasn't designed for like ding and dents, small dollar claims. And especially from the investor standpoint, we have a couple clients, more than 100 units, but there's, 2 claims on the record over 100 units, which is, really not anything at all. But there's a lot of carrier guidelines that say if there's 2 or more claims linked back to an owner, it's immediately ineligible. It doesn't matter if they own 100 or 100,000 properties, we immediately can't quote with them. So so we always want to make sure that our clients understand we want to use insurance for more of those catastrophic occurrences. Now, granted, if it's not a non-investor, just some guy who has home and auto, maybe doesn't have a great savings account for a rainy day fund, there's an argument to be made for those smaller claims. But certainly with real estate investors and active real estate investors or acquiring, we want to try to minimize the small dollar claims as much as possible and really use insurance for those more catastrophic events.
I love that story. I didn't know why insurance was created, but it totally makes sense. And it makes sense of how you can relate it to, why we use insurance. It's not to just get a little bit of cash back. It's not to protect us for the small things. It's to protect us from the super large events. I love it. I mean, that makes complete sense. Never heard it put out like that. So thank you for that.
Yeah, of course. And kind of one of the things we say is like, it's not really designed to be a replacement for capital invest. Like if your roof is just getting to the end of its life, you really shouldn't be using insurance to kind of cover those like CapEx costs. So we always say like, don't use it as a replacement for maintenance. And if you're not sure, like call us or like call whoever your agent is and chat through it before you call the carrier. Because that's another thing. If you ever call the carrier directly, whether you go through it or not, if you say, hey, this happened, I'm not sure what to do, it's recorded as a claim. And even if they don't pay out a $0 claim on your record, which still can impact your eligibility. So, I always say just like, use your agent as a resource, and something happens, like, let's have a conversation first before we immediately run to let's, try to submit a claim.
Is there a blacklist that like insurance companies can pull from? They can say, hey, Ryan submitted 15 claims, and then all these insurance companies look and go, oh, definitely not insured Ryan.
Yeah, so in pretty much every line of insurance, so something called like your CLU report, CLU, which links back all of claims that you potentially submitted. So even if it was under different entity names, if you have a couple of properties in this LLC and this, if you're listed as a financially responsible person, they could still potentially pull those. So really what carriers are looking, they're not necessarily looking for like severity, like, if you have a big fire, it's not going to be the end of the world. But what they're looking for is that claims frequency, that, X client is submitting a claim every year, every 2 years. So we're going to make an assumption as the carrier that we're going to continue to pay out claims, year after year. So either A, we don't want the business, or we're going to have to start charging, assuming that we're going to be paying out. So yeah, there's anything you do insurance wise, whether it's auto insurance, homeowners, or investment property insurance, that's all one of the probably biggest rating factors is prior claims experience.
That makes total sense. What should investors be asking their agent about their policy? Like if let's say they already have a policy, what should they go to their agent and say, hey, do I have this in my policy?
Yeah, so I mean, the number one thing is definitely settlement terms. So I would say see if it's replacement cost, if it's functional replacement cost, or actual cash value. That's the number one thing to check, because that's where people get hurt the most is purchasing the wrong settlement terms in their policy. So aside from that, I mean, and we can get into it too, there's a lot of optional coverages and endorsements, which we can certainly get into, but certainly as you scale, you kind of want to throttle back on some of that stuff. But the other thing I would say is definitely deductibles. See what your deductible is, and see what impact maybe using a slightly different deductible would have on the rate, and kind of run those numbers. So certainly as investors scale, I think those conversations change too. One policy going from $1,000 to $2,500 deductible isn't going to be crazy dramatic, annual savings, but doing that across 50 policies, that's definitely going to have a much more noticeable impact.
Yeah, makes total sense. I've noticed you talked about the declaration page. I'm familiar with the declaration page because I know a lot of people ask about the declaration page. I don't know what's on the declaration page. That's why I have you here. If an investor asks to see their declaration page, are they going to be able to see all the things they need to see about their policy on their declaration page?
You'll get 80% of probably what you need to see. You'll get enough to be dangerous. So you can make assumptions off of some of the things that you see. So like I was saying earlier, if you see your dwelling coverage is way low, you could probably assume it's either a actual cash value policy or there's some issue with it. But you should be able to see, your liability limits, deductible coverage amounts, everything like that on your declaration page. It only gets a little bit more complicated if you're looking for like specific claim information that, hey, if X happens, like, am I for sure covered on this? So that, you can read through the boilerplate language of the policy, but the cheat code is just ask your agent, and ask them in writing, ideally. So, if you have a hypothetical or something that you're not sure about, they should be able to get you an answer. And if they don't have one, offhand, that's fine. They might just have to check with the carrier on it. But the declaration page gets you about like 80%. But to really understand your coverage, you could read through the boilerplate of the policy, but it might put you to sleep. So I would always just say, have a conversation, with your agent, have them walk you through everything.
Gotcha. So the declaration page, as a clarification, is basically like a 1 or a 2 page overview of the policy.
Yep. Yeah. So like your actual insurance policy that you get, in many cases, they're 100, 150 pages in most scenarios. So the declaration page is probably like the top 2 or 3. So it'll outline your coverage, and then the rest 150 are all the boilerplate language.
I actually really like that advice of get it in writing. It's very much the former police officer in me, or like the lawyer that's like, oh, just make sure you send it to them via like an email so you get a response. And if they're like, hey, let me call you on this one, be like, why you got to call me on this? It's very easy. Answer to yes or no. Like, so it's interesting. I actually kind of like that strategy. Not that anybody's trying to get over on anybody, but
the insurance they're complicated products, and they're not all. It's not one size fit all. There's not really any standardized form that applies to every scenario in every state. Or anything like that. So like I always say, just err on the side of caution. And if you don't know or don't understand, ask. Because even carriers make mistakes sometimes where they might say, our interpretation of this language is that X should be covered. And then when the insured goes to put a claim through, they get a little bit of pushback on it. And then it gives you something to reference off. And then you say, hey, I specifically asked about this, and here's the response I got. And I, heeded that advice. So it just gives you a better foot to stand on if there's any ambiguity, I guess, in any like the potential claim scenarios.
No, totally. This is another question that I really like to ask in interviews. What do you see I want to say the best investors, but the investors that are really crushing it, they're really scaling it. How do you see them using insurance? Like, what is their system for insurance? Like deductible wise, coverage wise? What are they using? If I'm an investor that has 3 properties, and I'll look ahead and see what it looks like when I have 200 properties, what does that look like?
Yeah, great question. So there's a lot of optional coverages that you can throw into an insurance policy. So like a couple quick examples, like water backup coverage. If water starts flowing through the sump pump the wrong way in the basement, fills the basement up with water, that damage can be remediated by adding something called water backup coverage. Usually like $30 to $50 a property, use like a $5,000 limit. What we'll see a lot with new investors is they'll have their policies loaded up with a lot of these optional endorsements, which, $50 per property, times 3, not anything crazy, but 50 times 50, that number starts adding up pretty quick. Yeah. And then you can kind of start doing the math saying, okay, well, it costs me $50 a property. I have 50 properties. How many years do I not need to have a claim where I can just pay that right out of pocket and reimburse that, $5,000 loss?
Yep.
So really what we see as we scale as investors, and something that we recommend too, is start throttling back on some of those optional endorsements to really start using insurance, just like I was saying, as it's designed for those more catastrophic occurrences. So, and it's essentially just self-insuring. So if you own 15 buildings in Manhattan, all on Times Square, 99% of the time, those are self-insured captive insurance companies, basically self-insuring with their own loss reserve fund, a little bit of regulation sprinkled in, but really kind of mimicking that on a smaller scale is really something that we find a good thing to do. So, and the way you do that is just really not using insurance for any of those kind of like ding and dent occurrences, kind of throttling back on some of those optional endorsements that you don't really need as you scale. And then deductible wise is a big thing too. Deductible, you really want to look at least probably a $2,500 deductible, if not a little bit bigger for some of the bigger properties. So that you'll really start to see a noticeable decrease. You just lost a picture over there. Deal with that later. But
I will summarize what you said. That was the mic drop right there.
Yeah,
right. Let me just make sure whenever I need to really get right home a point, I'm just going to let a picture fall off the wall. But the summary there was less endorsements and higher deductibles as you scale up. Does that cover it?
Yeah, well, and then the other thing I was going to say too was, and this is really just a good risk management strategy too, is not to bundle everything on one policy. So again, going back like 10, 15 years, used to see this more where the admin of, 50 insurance policies was more difficult than is currently. So everyone would loop their 50 locations onto one singular policy called a master policy. And there's a couple negatives of doing that is if you have a bad claims year, maybe you do have 2 or 3 claims across those properties on that one singular policy. It's a very real possibility that the carrier says, we're good on next year. We're going to non-renew this coverage. So as the owner of all these properties, now you're stuck reshopping 50 properties with cancellation history, which impacts premium. So that was it at number one. And then number two is on those master policies, you share a singular liability limit. So if you have a bad slip and fall claim that exhausts that liability limit for the rest of the year until that policy renews, you're essentially running uninsured for liability, which is, those can be the really pretty devastating claims too.
Yeah.
So we always kind of recommend sticking away from those master policies, which we see a lot of investors doing. And then also from a pricing standpoint, if you're looping 50 scattered locations all with one carrier, number one, you're putting on a commercial paper. So anytime you put commercial on anything, insurance or loans, anything gets more expensive. And then also you might be forcing some locations onto that schedule that the carrier doesn't necessarily want to write. So they're going to charge you accordingly higher premium for them. So really by diversifying your insurance policies, that is always a big help for real estate investors, especially as they scale. So diversifies their liability, lowers costs typically, and really those concerns about managing policies, that doesn't really happen anymore. Everything's pretty much digital.
That makes sense. I mean, diversification as a protection. I mean, it totally makes sense. I mean, this is a personal question. I love to scatter personal questions in my interviews. For estimating insurance, I mean, I have a cash flow analyzer. How should I be looking at estimating insurance cost? Should I be looking at as square foot? Should I be looking at it as a purchase price? How do I determine what do I put in that analyzer? I think I normally put $600 to $800 a year because that's been my experience, and I just throw it in there. What formula can I use?
Yeah, so it's gonna vary dramatically by your geography too. So like for instance, the average homeowner's policy in Florida right now is like $7,500 or like something insane. Whereas in, Pennsylvania, don't hold my feet to the fire, and it's probably like $750 or something like that. So dramatically different depending on where your geography is. So I always kind of just for like a shooting from the hip number, we used to say about $500 a unit, and that'll get you enough to be dangerous. Typically with single family homes, like, freestanding structure, that's number's probably closer to $750 right now. Full replacement cost coverage, lower deductible Probably like $1,000 deductible. That gets you pretty close. As the buildings get bigger, you usually see a little bit of economy of scale there. So, that 750 per unit might drop to 500 if it's a really nice building, maybe if it's like sprinkler, brand new construction, maybe like $300 somewhere in there. So for like a good shooting from the hip number, not in Florida, I would always say if you're using 750 a unit and your numbers work, they'll certainly work if it's, actually comes in at like 600 a unit.
It's a super interesting point you bring up. I mean, a lot of buildings we invest in, 1920 build, does that drastically affect? I mean, if you're purchasing in PA, that's like an initial settlement, 1,700. How much are you insured? What, I mean, is that going to drastically affect your cost?
Yeah, so a lot of carriers, especially in like a post-COVID higher inflation world, they really started limiting eligibility on older buildings. So before, it didn't really matter when it was built, and it's a generalized statement, but effectively it wasn't too much of a big deal if it was built in 1850 versus 1950. It'd still be eligible at the same companies. Pricing be a little bit different, nothing too crazy. Really, a lot of carriers after COVID started getting out of the older habitational risks. So we see quite a bit more carriers restricting binding if the initial building construction date is over 100 years. Some carriers have bumped that all the way up to 1980, that if it's built originally before 1980, don't care if it's full gut renovation, anything, it's not eligible.
Sounds like my investment strategy. Get rid of the old buildings. They just have so many issues, but I don't file any claims.
The older stuff is definitely impacting pricing more from the perspective of before there used to be 100 companies that you could approach that would write it. So there's 100 companies competing for the business essentially.
Yeah.
And now that same building might be 10. So you're having a lot less options on the older stuff. So just by a factor of that, you're seeing increased premiums. Also, typically with the older stuff too, they're plaster walls, solid masonry construction, bubble framing sometimes. So it's the replacement costs are a little bit generally quite a bit higher. And that drives your insurance pricing too. So like if you're looking at 10,000 square foot multi-unit that's brand new sprinkler construction versus one built solid brick from 1900, it could be triple the cost. So certainly the older stuff is going to be a factor in your pretty decent size factor in your premiums.
That makes sense. I want to briefly touch back for that for estimating insurance costs. Your recommendation was use 750 as a rule of thumb, but it basically it's geographically it changes so much. So probably reach out to an agent. I mean, I'd say reach out to an agent, reach out to Ryan, get a quote from where you are. And then if it's somewhere around that number, then on each deal, you don't need to reach out to Ryan on every single deal unless you're going to purchase it. But then you can figure out, hey, this is my rule of thumb. Same thing with, I don't know how you do Florida, but we don't need to talk about it. It's a whole nother ball game. And then all I ever think about is I should start an insurance company in Florida. Like, there's no competition. You're against nobody.
Yeah, it's tough down there right now. So we feel for all the Florida insurance agents for sure.
Yeah. Rule of thumbs. I want to hit a bunch of rule of thumbs. You kind of said it already, but I want to hear your rule of thumb again for setting your deductible on just a single family property. What are you normally going to go with for your deductible?
The gold standard that you'll see with most insurance policies is 1,000. Seldom will you ever see anything under 1,000 these days. Where I would recommend is, and what I do for my own, is a $2,500 deductible. I find in most scenarios that gives the best price decrease in the actual premium, that $1,000 to $2,500 jump. Typically, the next step up from $2,500 is $5,000. You really won't see as much of a return on that change. Now, a larger portfolio, it still might make sense to go with a 5,000 or sometimes even higher. But, without seeing the property, without really knowing the client, I would say just as a general rule of thumb, 2,500 is usually the sweet spot. Now, that being said too is, and this is kind of circling back to what I was saying earlier about not using insurance for small dollar claims. Just because you have a $2,500 deductible doesn't mean you need to use it. I had, and I'll give a personal example of this. I had, one of my investments in Allentown, we do quarterly inspections, and my team went in there and they saw like the smoke detector was like melted. Like there was some smoke damage, obviously, but then like half of the cabinets were fine. Like the tenant actually started replacing cabinets for me. but that was actually kind of nice. Didn't like tell anybody, didn't say anything. We obviously, the tenant wasn't there very long after that. But what happened, they had a small cooking fire. They were able to extinguish it. And, like I said, it started replacing some random stuff. So that ended up costing me about, I think it was like $8,500 or something to, paint and kind of remediate it. Even with a $2,500 deductible, I didn't submit that through for an insurance claim. The way I looked at it, I'd get, 5-6 grand out of it. I now have a fire claim on my record, and I was aggressively buying at that time too. And I didn't want that fire claim impacting all my premiums across my portfolio. So long answer to your short question is like, I definitely say 2,500, but also just keep in mind that because you have a higher deductible, you don't necessarily need to be using it all the time either.
Yeah, and to just give it even go further into that example, but very short. If you have 20 properties and all of a sudden your insurance raises your rates $100 per property, I mean, now all of a sudden you've gone up $2,000.
Yep. Yeah. So I mean, your trail is looking at 5 years of increased premium before that's completely off your record. But where it becomes really a problem is if the frequency starts to go up. So that one claim wouldn't necessarily killed me, but certainly when I'm aggressively buying, that time horizon where your break-even point gets a little bit shorter, where it makes sense to kind of self-insure some of the smaller losses.
And that also goes to your point of the diversification of, maybe multiple carriers, 2 or 3 carriers if you have that many properties. That's awesome. Yeah, I like that rule of thumb. Rule of thumb for making a claim, and I know we briefly hit this, but is there a dollar amount, or I mean, is it all just, hey, it depends, it depends, it depends?
Yeah, so I mean, it's definitely going to vary by who the property owner is. So if someone has 1,000 properties, that number is definitely a lot different than someone who's just buying their first property. So the rule of thumb I would say is talk to your agent and walk through what happened. And typically, like if it's not something catastrophic, like God forbid house burns down, of course we're going to use insurance. But maybe if it's something like what I had, like a smaller kind of kitchen fire that didn't impact, like 911 was never called, something like that, have a conversation first. And my advice in that scenario would be, before we submit a claim, get an estimate on what it's going to cost to repair, so we have some hard numbers to work with. And then we can make that decision of, hey, is this going to like wipe you out like your reserve fund, completely if you had to pay this out of pocket? Are you actively buying stuff this year and the next couple of years, or is like this once and done? All those things kind of roll into that advice. So I would say that for a rule of thumb here, have that conversation with your agent to see what makes sense given your specific scenario, because that's going to vary dramatically for everybody.
Gotcha. For replacement cost and coverage, I mean, what's your rule of thumb that you normally tell investors? Hey, and let's give a real life example here. Let's say I purchase a property for 125 and I put 50 into it. So I'm all in 175. And let's say, and I'm thinking about a real life example right now, but let's say that property is worth 275. I'm all in 175, property's worth 275. What are you recommending to me for my coverage to be? And this is a single family. This is a 5-bedroom, 2-bathroom. This is a 2.5 bathroom, and it rents out for $2,400, and it's in Baltimore.
Okay, gotcha. Okay.
And it's on the 1600 block of North Carolina.
So typically what you're going to see with replacement cost, generally speaking, for investment properties, typically, and especially if they're older, if they're in an urban area, you're going to see the replacement cost typically, maybe it could be 2x what the purchase price is, sometimes more, sometimes less. So the replacement cost doesn't actually have anything whatsoever to do with the actual market value or purchase price of the property. So your purchase price of property obviously has the structure in there itself, but also the land value, and also factors that don't necessarily impact the cost to construct a property. Like, is it a good school district? Are there, close amenities to the property, things like that. So with replacement costs, you can see it vary on either side of the market value. And an example I give is like, one of my investment properties in Allentown, it's probably, I think it's around 2,000 square feet. We're seeing replacement costs of about, $180, $190 a square foot. Whereas, and I paid, make up a number, maybe like, 90 grand for the property. So significantly more than the actual market value of the property. Whereas like my primary house, vinyl siding, drywall, nothing crazy, just in a suburb in Bethlehem, the market value of my house is significantly higher than the actual cost to rebuild because it's, built in 2015, just frame construction. Like I said, nothing too crazy. Like the other example I give clients too, when it comes to replacement costs and kind of just like thinking about it, is like if you bought, say, my primary residence in the suburb, brand new construction, and you're going to buy it for $500,000, your insurance costs wouldn't be $500,000 for the replacement cost, because if it costs $500,000 to build that house, and buy the land, the builder's going to be losing money on that deal. So new construction of homes, drywall, vinyl siding, you'll see the replacement cost typically be lower than the market value. Whereas with investment properties, specifically like masonry, plaster walled properties, that replacement cost could be dramatically higher than the actual market value.
So, and for this example, for the 5-bedroom, 2.5 bath, it's an all brick property.
Yep.
That replacement cost is going to be way high. It's probably going to be.
Yep.
It's probably going to be 400,000 or 375.
Yeah, it could be. I would say like, they're kind of just shooting from the hip, like estimate like 190 a square foot for replacement costs. It's usually easier to go off of like a square footage versus square footage, and type of construction probably gets you the closest for.
Yeah, I gotcha. Are you recommending, and maybe I'm asking the question wrong. Are you recommending that you want your clients to have that replacement cost as what the replacement cost is? Or if you're does that advice differ if you're a savvy investor that has kind of a yellow book of contractors that you can get the work done? As an investor, I look at it as like, man, even if I have a massive fire, I'm going to be able to get that renovation done at a significant discount compared to if the insurance company brings in a crew and they do it. Theirs is going to be 3 times what there's going to be.
That's a very good way to frame that question. And I've had a lot of conversations with actual like home builders that we insure their investment properties, and then they look at the replacement costs. They're like, Ryan, what are you doing to me, man? I know I could build this property for X, but the way the insurance carriers calculate the replacement cost, they can't factor in that you're doing your own work, or you have an uncle who does build it for no profit. So they look at essentially market rates of construction costs with current materials costs, and then a profit margin built in for the builder, because there are no builders off the street's going to take a property where they're just buying the work. So the replacement cost it's calculated on the carrier side, and every carrier run it a little bit differently, but generally those numbers tend to be pretty accurate on what it would actually cost to reconstruct a property brand new from the ground up. Now, what you have to be careful with is what's called the co-insurance provisions of your policy. So pretty much every carrier, if not 100%, they'll have what they call an 80% co-insurance requirement, meaning that if they estimate that it's going to cost $100,000 to rebuild the property, you need to insure to at least 80% of that number to still qualify for the full replacement cost on the policy. So, and if you don't do that, number one, it'd be pretty hard to find an agent who would knowingly violate that. But if you say that property was $100,000 to rebuild, that was the estimated replacement cost, and you insured to 50%. So you had a $50,000 policy limit. What happens if you have a kitchen fire and say it's $20,000 fire? They apply a 50% penalty to that number. So that $20,000, immediately they cut off $10,000 from that, and then they subtract whatever your deductible is. So that co-insurance penalty it's a very kind of hard concept to really get a lot of people to understand, but it's critically important for your coverage, because you could really get in a lot of trouble, if there are those co-insurance violations. So my always recommendation is like, if you see something that looks like way off, at least have the conversation with your agent of like, hey, why is this replacement cost X? Can you show me how you got to this number? And you can see if maybe there's a discrepancy in the square footage, or, maybe the property was completely gutted or something, and, something dramatically changed on it that should have an impact on that replacement cost. So I would always say insure to whatever the carrier calculated number is. But, if it doesn't look right to you, or you just have questions, just ask them, and then you could have that conversation of how they got there.
Yeah, I guess my question was, can you throttle the replacement cost? But you kind of went into why you don't want to throttle the replacement cost way down.
with
if you can't.
sometimes to a point. So you can
It's
never get it to, some carriers will say, hey, this is what we calculate as 100% replacement cost. This is
Yeah.
what you have to buy. We're not going to sell you anything else. There are some carriers where we have a little bit of freedom to go down a little bit, but you have to be careful with that whatever the co-insurance provisions are on that policy. So, and it does vary a little bit between commercial lines and personal lines. They'll have different requirements.
Yeah, I'm glad you brought that co-insurance up. I've actually never heard about it before, except prepping for this interview, watching other insurance videos on co-insurance. Like, co-insurance. I never even heard of it before. So thanks for letting us little guys know what it is. Is there a rule of thumb for liability that you want to, slip and fall case?
Yeah, I would say the gold standard is 300,000. So that's, you have $300,000 in liability, you should be able to sleep just fine at night. Most commercial policies, they'll start out at like $1 million in liability, which is fine. There's nothing wrong with it, but certainly you don't need that on every property. And then you can reference this too by the amount that the carrier is going to charge you for the liability, how likely you're actually going to potentially see that claim. So like if you do a $300,000 liability limit on a single family home and you bump it up to 500,000, the carrier realistically might charge you like $8 a year for that additional 200,000 in coverage. So as the consumer, it tells you how likely they feel they're ever going to have to pay out that additional 200,000. If they're going to charge $8 a year for it, like how many policies would they have had to sell just to break even on one single liability claim where they paid out $500,000 versus 300,000. Actuarially, the math doesn't really support that you need that high of a liability limit. Also, defense costs are never held against your actual liability limit. So if you have a $300,000 liability limit and they spend $750,000 on defense costs, that doesn't go against that $300,000 limit. Only that eventual settlement be what is subtracted from that coverage limit.
Interesting. So it doesn't matter if you have a ridiculously long trial.
Yeah. And chances are, there are not a lot of insurance cases go to trial. Most are settled. I think that a lot of the plaintiff's attorneys kind of count on that. And really the slip and falls we see, like probably honestly an average of maybe like 15,000, up to 20,000, the high end. They really don't settle for, I think what a lot of people think they do. Now, certainly there's like in Philadelphia and in some other more densely packed urban areas, you can see that go up a little bit more, but by and large, your six-figure liability claims are exceedingly rare. And you can, again, reference that off of the premiums that they charge for liability versus what they charge for property damage.
Makes sense. Those are all great rule of thumbs. For investors, should they consider umbrella policy, master policy? I know you briefly touched on master policy earlier, or should they just be insuring their individual properties?
Yeah, so certainly with master policies, we don't really ever recommend those anymore. Umbrella policies, essentially, you're just, for those who don't know, you're essentially increasing the underlying liability limits on whatever properties, or other policies like home and auto that you have scheduled onto that umbrella. Certainly as you scale, I don't think an umbrella policy becomes, an expense that I would recommend. So really the purpose I see for umbrella insurance is really what I'd say, like to protect you from yourself. And what I mean by that is, like I was saying, from the investment standpoint, six-figure claims are extremely rare. You're really not going to see those crazy claim numbers that would justify an umbrella coming from the real estate investor standpoint. Now, if you were to like blow through a red light because you're texting and God forbid you seriously injure or kill somebody in that auto accident, their surviving family members are going to sue you for very specific number. It's called their human life value, which is pretty morbid, but it's essentially your annual salary to age 65. So if you kill somebody who's making $100,000 a year, they're 55 years old, potentially could be on the hook for up to $1 million. So if you do see that lawsuit coming from an auto accident, it's possible, unlikely, but possible that there's a case made that, well, you have all these other business assets, you don't live in any of these properties, they should be available to creditors. So the umbrella policy sitting over a personal auto is really what I would recommend, if anything, to really protect the rentals from that backdoor liability, as I call it, which is you doing something personally, getting sued for it, and then it potentially impacting your portfolio. So the umbrella policy there kind of takes that out of the realm of possibilities, because there's that big bucket of money essentially on that liability limit that, prevents that from happening.
Gotcha. And I mean, the LLC would normally protect that, or a corporation would normally protect that. And it's open. There is a little bit of liability. It has been piercing the corporate veil or whatever you want.
And what we'll see too is, like, if there is a slip and fall case, like, everyone's getting named in that lawsuit anyway. So it's like the LLC, it's the property manager, whoever owns the LLC, like Great Aunt Millie, like whoever they can possibly think to put on that lawsuit, they're going to name in there, and then it's still up to you to defend it, to get your, why your name shouldn't be on there personally. But either way, you're going to court. So I always say, like, and again, I'm not an attorney, so I don't want to give legal advice here, but I don't think the LLC in a lot of scenarios gives as much protection as you might think, especially with like investment property business, because there's still that responsible party. So like the LLC isn't a real human that can sit on a witness stand. It's going to be like an individual human, typically the responsible party for that entity. So I always say, like, the LLC, great. There's other tax benefits and things that like diversifying that way, but from just a pure risk management standpoint, insurance is really the best way to completely protect from that exposure of those lawsuits for bodily injury. So as long as your insurance is tight, you're definitely in a lot better position where the LLC almost becomes irrelevant.
And we'll hedge that with consult your attorney.
Yes.
Please consult your attorney. Do not consult me. Do not consult Ryan. Please consult your personal attorney.
Please.
If you have questions, do not take that as legal advice. Is there a difference between traditional insurance agents and like brokers like yourself?
Yeah, great question. So I kind of think brokers and independent agents, you can kind of use those terms interchangeably. So an independent agent or broker is essentially someone who just has access to multiple carriers. So that's contrasted with what we would call a captive agency, which is somebody typically like an Allstate or a State Farm, where if you go to State Farm, they're really only showing you State Farm options because that's the only carrier they have. So going with an independent agency, you have a lot more options because they have access to a lot more carriers. So that would be the differentiator, I would say, is independent agency / broker versus a captive insurance agent.
Okay. And you would recommend going with a mortgage broker over a captive agent, or does it really matter, or do the rates matter? If you have more competition is always a good thing. But
yeah, I mean, you definitely want to have options. You're not pigeonholed into one carrier. So I make a joke that like State Farm keeps us in business, which is not really true, but it's like their products for investors these days aren't really that competitive. So if you only went to a State Farm agent, you're only seeing that product that's probably pretty pricey and might have some limited coverages that you want to avoid, versus going, with an independent where you just have infinitely more options for coverage. As a generalization, you're going to see better coverage and you're going to see better pricing with an independent versus a captive company.
That has also been my experience with you, Ryan. So for flippers, you're purchasing a vacant property and you're never actually putting somebody in. How are you recommending to insure that property? It's slightly different than rental, than normal insurance.
Yeah. So it's a specific type of policy. So you either like they call them like a builder's risk type policy or vacant renovations type policy. So the occupancy is extremely important with insurance companies and coverage. So anything that you're buying, there's nobody in there. You're gonna do significant updates or upgrades to the property. That gets insured on a separate policy form that's specifically designed for those renovation type risks.
Gotcha. So just slightly different, slightly higher rates.
Yeah. I mean, generally speaking, if you're looking at like an annual premium for an occupied one unit versus like a dwelling renovations policy, it could be 2 to 3x the cost for the renovations policies. But again, the ambition is that you don't also have it a whole year, that, hopefully your renovation moves a little bit quicker than that. Also, there's definitely more exposure on a renovation type policy. So the example I always give is like, if you have an occupied policy and God forbid a little fire breaks out or there's a water leak or something like that, there's someone there who's probably going to call 911 immediately as soon as they notice it, or maybe be able to put it out if it's a small cooking fire or something like that. Yeah. Versus if it's a vacant policy that's undergoing renovations, by the time 911 gets called, it's because the neighbors are, seeing the flames or they're smelling the smoke in the middle of the night. So they're much more likely to be a total loss versus an occupied policy where there's essentially a security guard on the property. So That's why you'll see them a little bit, or not a little bit, quite a bit higher premiums. But again, the biggest thing with insurance is like cheap insurance gets real expensive when you actually need to use it. So we always want to make sure you're accurately insuring your exposure, because if you somehow get an occupied policy on a renovations risk and there's a fire, the carrier would be within the rights to deny coverage. So
Gotcha.
that a couple $100 savings gets pretty expensive when there's no coverage that applies.
Yeah, there's no reason for you to actually have it because you're really not covering anything. So
just bought a stack of paper, basically.
Interesting.
A lot more than you can get it for on Amazon.
These are the last two fire round questions. I mean, you can just answer them very shortly. Do you require your renters to have renter insurance?
I do. I think it's a great idea. Not only does it make them kind of the low-hanging fruit if there is any kind of liability issues, like dog bites, anything like that, the renter's policy will take precedent and keep it off of your claims record. You'll still get sued, don't get me wrong, as the owner of that property if there is something like a dog bite, but the tenant's renter's insurance policy will really take kind of the first line of defense there. Also, just from a life safety standpoint, I guess you could say, I think it's just important for renters to carry it, because we have seen a ton of losses where there was a fire in the middle of the night, tenant runs out of the building, every earthly possession they had, including their wallet and cell phone, was in that in their apartment, and that it was all completely gone, just had to close on their back. So without renter's insurance, there's obviously no coverage for them. And for the amount that renter's insurance costs these days, like $80 to $100, for like $25,000 in personal property coverage and $300,000 liability, it just makes sense to have. So you can almost kind of force them into doing something that's ultimately going to be good for them.
And I'm 100% suing you for $25,000 for Brandy's photo, because there's only one. I don't have another one of those. That was took on a flash camera back in the day. Last question. When do you reshop insurance? When do you reshop your policies?
Yep. So we automatically look for our clients every year. Very seldom does it make sense to look midterm. There's some exceptions if we would bring on another carrier, or something like that we feel might be really competitive. But the general rule is look at everything every year. So chances are, just like ours is, most agencies have software that automatically sends things out and kind of gives a ballpark rate if there's going to be a better premium. And then we just go in and kind of do the last 10%. So I would definitely look at it every year. If you have an independent agency, chances are they might already be doing that for you. But certainly if you're with a captive, they don't have anyone else to shop for you. So that's probably not happening for them. But generally speaking, I would say every year. Now, the one thing that I know we're not really supposed to get into auto insurance, that's the one exception to that rule is the longer you're with an auto insurance carrier, up to 5 years, when you go to switch, you look much more attractive. So if you're in, this is kind of like a bonus fact. If you're looking at auto insurance and you switch every single year for $5 in savings, you're really hurting yourself, because you're arbitrarily keeping those rates high and not really ever giving it a chance to gain those longevity credits. So auto insurance every couple of years, property insurance every year.
I mean, I'll let you throw out any other super insurance tidbits to get people pumped about insurance. Any other huge things you're you have to know this about insurance? When I go to a cocktail party at Ruth's Chris Steakhouse, I am telling people this.
Replacement cost terms. That's the biggest thing, I think. Okay. So it's those settlement terms, man. That's probably the biggest thing, where we see people, make mistakes. And the biggest thing that probably has the biggest dramatic impact on, how your policy performs when you actually go to use it. So, So nothing else, just that.
Okay. Well, if you guys aren't already pumped about insurance, how can the audience reach out to you, to Lehigh Partners? How do they reach you guys?
Yeah. So, you can just go to our website, just lehighpartners.com, contact us forms on there. That's probably the easiest. Our phone number's on there as well. So, shoot us a message, give us a call, and we always just love having conversations. So, even if you don't own a property yet and you're just kind of curious about, what insurance might be in an area that you're interested in investing, we love having those conversations too.
Yeah. And we'll put all Ryan's contact information in the description. Thank you, Ryan, so much for educating myself and the guests. And we will see you guys on another episode. Thank you, guys.
Thanks for having me.